Over the next 30 minutes, you are going to learn every single lesson that I have learned in my now 10 years of trading experience. Now, I don't ever script my videos, but I pretty much always go in with some sort of layout. For this one, I'm just gonna sort of fireside chat with you. I just want to talk through, in no particular order, what I have learned over the process of the last 10 years to become a profitable trader. If you watch this entire video and maybe rewatch it with a notepad and take notes, I can't promise you it's going to make you a profitable trader. I can't do that legally, but I can promise you it's not going to hurt. You will be a better trader by the end of this video. And let's start right away with some fun stuff. Let's talk about a chart pattern that I have found helps just a ton, and it has to do with identifying trend. Identifying trend as a beginner trader is very easy. If a stock's going up, it's an uptrend. If a stock's going down, it's in downtrend. But you need to be able to give a value to that. You need to be able to objectify when a stock is actually in uptrend or downtrend. I have found the most useful way to do so is by using the simple moving average study and setting it to a length equal to 200. This is a price action study. All it's doing is it's plotting the average closing price out of the last 200 bars, and it provides you with a very easy value that you can now say if the ticker is above this line, it's an uptrend. If it is below this line, it is in downtrend. And just the best way to go about this as a bullish active trader, which probably 90% of you watching are, just don't touch stocks when they're below the 200 simple moving average. XYZ is a stock that's a great example for this because it has a huge move up and a huge move down. You could have bought all the dips you wanted to above the 200 simple moving average here, and really you could have applied any strategy, a continuation strategy, a reversal strategy, using the RSI, using crossovers, using price action. You could have done whatever the hell you wanted to, as long as you were buying when it was above this 200 simple moving average. You were going to make money, right? Then as soon as it crosses below the 200 simple moving average here, if you simply went, okay, I watched that video that Trading Stocks made. He said don't touch stocks when they're below the 200 SMA. I'm going to stop buying this thing. You would have protected yourself from all of this downside. And I can go look at like any random stock. Let's pull up Tesla and it will give you a similar example. Right here, apply, dude, whatever strategy you want to apply. Oh, you learn so much. You spend so much time studying strategies. The macro trend is really what you need to understand first. Apply whatever strategy you want to this chart when it's above the 200 simple moving average, you're going to make money. Apply whatever bullish strategy you want to when it's below the 200 simple moving average, and you're likely going to lose money. This value, this study, this price action indicator is so vital. Now someone's going to pipe at me, well, Trey, you actually did pretty good buying Tesla down here in the long run. This whole video is going to be about active trading. That is a different conversation from investing. Investing being you're going to hold this ticker for a minimum of 12 months. If that's the case and you really believe in the company and you've done your fundamental analysis, this, that, and the other, then yes, you should be looking to buy as much blood as possible. Buy the stock as cheap as possible. But for active trading, like you want to be in the stock and out of it, usually like no longer than 2 weeks, you did not do well buying this thing below the 200 moving average. Let's continue this conversation, and in doing so, bring in another study. And I'm not really going to do this to say that I think you should use the RSI or whatever, but it's really just going to help give a visualization to the overall statement I want to make here. Why does buying stocks above the 200 simple moving average work? Because at that point, you are agreeing with the market. You're not trying to fight against the whales. Everybody and their mother, the billions and trillions of dollars that go through a stock like Tesla every month, are selling this thing really hard, and you think you're going to be the different person that times the bottom. No, you don't buy when they're all disagreeing with it. You buy when everybody else is buying. You just tie your rope to those whales and you ride that profit along the way. The same idea can go for the relative strength index. I very, very often see beginners wanting to buy the relative strength index when it is down and below 30. That is what they consider oversold and it's due for a bounce. Well, Tesla crosses below 30 on the RSI here. You did not do very well. Tesla crosses below the 30 RSI right about here. You did not do very well, at least in the short term, right? Stop thinking you're smarter than the market. That's the really overall larger picture I'm trying to paint here. You will do so much better. You will perform so much better if you just agree with what the market is saying. When a stock is going up, be bullish on it. When a stock is going down, be bearish on it. Once again, at least in the short term, which is what we're talking about here. And I'll just piggyback off that same statement with my next lesson. Buying a stock just because it's down a lot is not a very good strategy. This is United Healthcare. They had a massive gap down a few weeks ago, and then even a week or so ago, news came out that they were under some sort of federal investigation or something. Well, all I saw all over Twitter was everybody wanting to buy this stock, just because United Healthcare has been an absolute animal. I mean, this stock is a beast for years and years and years, and then it gets this massive dip. So what do retail traders do? Oh, it's a really strong stock on a really big dip. I should go and buy it. So much retail inflow, so much retail money went into this stock around 450, 440. Well, this is not even at about a month later. It is now 150 points lower, trading at $300 a share. Do not rush and go buy a stock just because it's down. That's not a strategy. Stocks go down for a reason. This market is more efficient than you can even imagine. That you have not figured out that this stock is going down for no reason and you're going to time the bottom once again. You just haven't. Stocks go down for a reason and should be avoided when they go down this hard. In that same sentiment, stocks should not be avoided or even worse, shortened just because they're up a lot. I have very vivid memories of Twitter talking about Nvidia in late 2023 when it was trading right about in this range because it had just made a move from, and I think these are post-split prices, but $14 up to $40, $50 a share. The price to earnings ratio at the time was like 150 or something like that. Everyone's like, oh, you're an idiot. You would be such a dummy to buy this stock here. I'm going to short it, etc., etc. And obviously, as you can tell, and as you probably already know, Nvidia has just been an absolute rocket ship since then. Once again, just to continue the same sentiment, just like stocks go down for a reason, stocks go up for a reason too. Once again, you are not smarter than the market. You will be a better performing trader if you just start siding with the market. Now, this might be even the most important lesson that I have learned, because for the first, up until 2020, so that was it was 5 years ago now. So for the first 5-6 years of my trading career, I was a discretionary trader, right? I just went in and I had ideas and maybe some loose rules that I would follow. And in the latter half of my trading career, I have been a system trader. What being a system trader means is I have real defined objective reasons for why I enter and exit trades. And I do that because I have proven in my back testing and in my forward testing that these strategies have a profitable edge over the stock market. For example, I'm looking at this Nvidia chart here. As a discretionary trader, or even just coming up with a trade idea in general, I would say something like, I want to buy strong stocks when they dip. That is a very common, if not the most common trading ideology for retail traders. But it means nothing unless you give it value. Like, okay, strong stocks when it dips. That's like a great idea, but what does it actually mean? When is the stock considered strong? When is the stock considered on a dip? You can't just eyeball it and roll with that. You will lose money. I'm going to go ahead now and flick over into my reversal layout, and you will see, and let's actually load up that Nvidia chart just so we're looking at the same thing. You will see what I mean here. So I have built an actual trading system around that idea. We talked about this a little bit with the 200 simple moving average. That is how I objectify that the stock is strong. We are up and above that 200 simple moving average. And then I utilize the RSI. If we're above the 200 simple moving average and the RSI is below 40, then we enter the trade. That stock is both strong and currently on a dip. So objectifying your trade systems in that way is so important. Not only because then you get to actually see the statistics and prove and optimize the statistics around the strategy, but also how do you build where's my reversal? How do you build a watch list if you haven't objectified exactly the values that you're looking for in your trading system, right? Like I have a reversal watch list built here. This will show me any stock that is currently above its 200 simple moving average and less than 40 on the RSI. Because I have given values to the reasons for why I take these trades, it allows me to build a scanner to find the stocks that I should be looking to enter every single day. And that's vital. Doesn't matter how damn good your strategy is if you can't find the chart setups. I bring this up now because we're about to move into the next very important segment of this video, in which I'm going to talk about what I have found works best in trading strategies over my last 5 years of building them using custom codes. Custom coded strategy studies and scanners is the niche that we cover on this YouTube channel. And if you are interested in getting a head start on your own codified trading journey, I have published over 150 of my own custom Thinkorswim codes over on my website, daytradingstrategies.net. There's even a handful of free ones that you can go and access now. So the link to this website will be in the description down below the video. At least go take advantage of the free codes, read the reviews while you're over there, and decide if it's something that could help accelerate your trading journey. Next, I want to talk about how freaking awesome the average true range indicator is for determining stop loss and profit target. If you don't know, the average true range shows you the average distance between high, low, and open and close over the last 14 candles. So basically, it is just showing you the average change in each candle over the last 14. So as you can see here, we're looking at the SPY daily chart on the dip we recently had. Of course, during dips like this, you get a more volatile market. The average true range jumped from where it was before at just 9 points a candle all the way up to over 19, even 20 points a candle at the peak here. So let's say, and by the way, also I have just turned on a quick study. I'm about to make 100 unnamed study, guys. This is new study 99, but I just built a quick study here that shows the close of the previous candle plus the average true range and close of the previous candle minus the average true range, just so you can have that visualization on the chart. But say you wanted to play this dip here. Say, okay, SPY is dipping really hard. I'm going to buy the close of the first green candle. A very common trading strategy. Well, so you buy the close of this candle here at about 505 a share. Now, because of the average true range, you recognize that, hey, this stock is like really volatile. Like the next day, when your first trade candle that's open, the average true range is at 16 points. So you should understand that you need to be ready to give this thing 16 points of downside risk before you get stopped out of the move. This is just a really volatile time in this stock ticker. So you need to be able to give it its natural space to breathe based off of how volatile it is. That does a couple of things. One, it allows you to adjust your stop loss based on recent volatility. And two, and maybe even more importantly, it allows you to objectify position size. If you're willing to risk $5,000 in this trade, then you know, okay, I'm going to need to give it 16 points of downside risk. So whatever 5,000 divided by 16 is, that's how many shares you buy. But look at what ends up happening on this day, right? You bought at 505. This stock makes a move down to 489. A lot of times, beginner traders would just sell there. Oh my gosh, this thing's making a move down. I need to just go ahead and get out of this trade, lock in the loss. But since you're using the average true range and you understand that is within the average true range bands, it is not exiting its natural volatility bands over the last 14 bars, you don't sell because it doesn't quite touch that close of previous candle minus ATR value, which is at 488.32. So you don't end up getting out of this trade on this dip, once again giving it its needed space to breathe, and then the next day gets a massive move up, moves up above that close of previous candle plus ATR bar, and that is where you can lock in your profit when this stock closes up above this bar, which it does at about $548 a share. I use the average true range indicator in a lot of my codified trading strategies. The sort of example we just went over was not a real strategy, that was just a quick visualization. However, what we're looking at now is one of my real strategies. This is my continuation large cap swing trading strategy, in which I use the ATR for 2 of my 3 exit conditions. Both of the ATR exit conditions you can see plotted on the chart by this cyan line and this pink salmon colored line. The cyan line is, once again, just like we did before, close of the previous candle minus ATR multiplied by 2.5. So whatever the ATR value is, I multiply that by 2.5, subtract it from the close of the previous candle. If we touch that, so basically that is my, if there is a very volatile downside day while I'm in this trade, if we touch that line, I lock in the profit, as you can see occurring in this trade here, whereas the salmon colored line is my entry price minus the average true range times 1.5. So if we close below that line, that is my stop loss on the strategy. So I'm utilizing the average true range in a couple of different ways as my exit for my strategy. Once again, I love doing it because it is always tracking the current volatility of the ticker. If the ticker is more volatile, gives it more room to breathe. Whereas if it's less volatile, it goes ahead and tightens up that stop loss because there's no need to give SPY, 20 points of downside room to breathe. If the ATR is sitting at like 6 points, you're just wasting downside protection at that point. You've now gotten to see both my reversal and continuation swing trading strategies throughout this video. And in building both of these strategy types, I have learned a handful of lessons. The first and the most obvious is the win percentage here. You can see it's sitting only at 37%, and this is on my continuation trading strategy. But the strategy still makes money. It's still sitting at even a max drawdown percentage of only 22%, which is very malleable, very workable. This is a strategy I actually trade with, right? However, look at your average win, just over $2,500, whereas the average loss is less than $800. So a continuation trading strategy, meaning a strategy in which you are buying high and looking to sell higher, your purpose, the way you're going to make money, is by targeting a high risk to reward ratio. Whereas if I turn back on my reversal trading strategy here, you can see my win percentage jumps all the way up to 88%. However, my average win being $500 and my average loss being $374, that's actually a little bit higher than it normally is. Let's hop over to another random stock. Let's go to Apple. Okay, this is a bit of a better example. 74% win rate, but about a 1-to-1 risk reward. The average win being $1,100, the average loss being just under $1,400. So in a continuation trading strategy, you're targeting a high risk reward as your profitability metric. In a reversal trading strategy, you are targeting a high win percentage as your profitability metric. You do this, of course, by, in a continuation trading strategy, letting your winners run. If I pull back up my continuation trading strategy, you'll notice here I actually don't even have a take profit when I'm building continuation trading strategies. Instead, I have trailing stop losses. That's how I build them. Buy strength, let the strength continue for as long as it can. Once the stock objectively proves it's no longer strong, then you get out of the trade. Once again, there's no even profit target I'm looking for. I'm letting my winners run as large as they can. Whereas in my reversal trading strategy, I'm getting out of my trades very quickly. I'm in the dip, out on the first sign of strength. And I even take my reversal trading strategy a step further to target even a higher win percentage by scaling into the trades. The only reason you're allowed to make money trading stocks is because you're able to take on risk that the big banks and hedge funds can't. That is one of my quotes. It's a quote I came up with myself. It's one of my favorites. I've got a handful of quotes. That one's one of my favorites. I want to touch on now the downside risk of each one of these strategy types, being continuation and reversal. Once again, because every strategy is going to have risks. There is no such thing, as much as I don't want to burst your bubble, there's no such thing as what gurus will tell you should be targeting 3-to-1 risk reward and greater than 70% win percentage. That just doesn't exist. Guys, if that existed, I'd make a video on that and we'd all be driving around in Lamborghinis. The game is not that easy. Every single strategy has a major risk. And I'm going to talk about in just a second how you work your strategies within one another to help alleviate those risks. But in the reversal trading strategy, it is that you can get smacked. You can get absolutely hammered in individual trades using this strategy. SPY, the S&P 500 is a great one to trade with this strategy because the S&P 500, the way it rebalances, is always built to go up over time because of its rebalancing. But you can see an example here of how it's began scaling into a trade. This is during COVID lockdown, gets absolutely hammered before eventually getting that bounce back up. I do think it took a pretty bad trade on AMC. Got into this trade here. Luckily, it only bought once. It didn't scale in a bunch of times, so it's not in a big position, but gets absolutely hammered before ever getting a chance to get out. So that is the major risk of a reversal trading strategy like this. You can get absolutely demolished in individual trades. Whereas the major risk in your continuation trading strategies is you can go on cold streaks. The strategy averages about a 30% win percentage. You can very easily go 7, 8, 9, 10 trades in a row with this strategy without ever catching a winner. That is the major downside risk of the continuation trading strategy. The way you alleviate these risks of these individual strategies is by trading them together. Once again, an individual strategy is never going to have just a really, really nice, just even, smooth P&L curve, because there's going to be moments in your continuation where you go through one of those cold streaks. There's going to be moments in your reversal trading where you get absolutely shellacked in one of the trades you take, and it's going to make that P&L curve look disgusting. The way that you smooth out your own account's P&L curve is by trading multiple strategies of multiple different types at the same time. So you're trading 1 or 2 continuation trading strategies. You're trading 1 or 2 reversal trading strategies at the same time. That's how you alleviate each other's risk. If you get absolutely hammered in a reversal trading strategy, that's okay, because last week you caught a huge winner in the continuation trading strategy. If you go 7, 8, 9 trades in a row that are losers in the continuation trading strategy, that's okay, because you've had 12, 13, 14 wins in a row with the reversal trading strategy. You see how if you utilize both strategy types together and at the same time, that is how you make a pretty consistent P&L curve within your own portfolio. And I should mention as well that trading 3 or 4 different strategies at a time forces you to not be all in with a single strategy. I had to scroll back a while, but this is the 2000 .com crash in the S&P 500. This is the reversal strategy and one of those trades that it gets hammered. Luckily, it only buys once, so it's only in 1/10 of the reversal trading position size anyway. But since this is just one of 4 strategies you're taking, it's also only 1/4 of your portfolio's entire portfolio, should I say, that is in this trade. So yes, even though it drops from 145 and you don't get out till 117, losing 28 points in this trade, it's only with 1/4 of your portfolio. It's not actually going to crush you. In fact, in this trade, you go from being up $5,700 to only being up $4,800. You lose $900 in this trade. Once again, it only scaled in once. Actually, not a big loser at all for the way I have my reversal trading strategy set up. But just in general, once again, trading multiple strategies forces you to not be all in on one, so that whenever one of those, and yes, it will happen. If you're trading a continuation strategy, you will go 10 trades in a row without a winner. If you're trading a reversal trading strategy, you will get hammered in a trade like this. If it hasn't happened to you yet, don't worry, it's coming. Just make sure, once again, if you're trading multiple strategies, even when it comes, it won't hurt you that bad. So for the last 15 minutes or so now, we've been discussing codified and objectified trading strategies and the statistics around them. I want to talk about now the process you go through from building and optimizing a strategy to actually taking real money trades with it. What you are seeing here in the statistics running up in the top left, these are all back-tested statistics. This is proof that the strategy works on existing and static data, which is like great, but doesn't really necessarily mean the most in moving forward. Like, is the strategy going to actually work in real time? What you need to do next, after you have built the strategy to be as profitable as possible and at the lowest max drawdown percentage as possible, this is what I find to be the most important statistic. Strategies that have a lower max drawdown percentage tend to translate better to live trading. I won't take any strategy from back testing and even move to the next step if it has a max drawdown percentage greater than 30%. But anyway, the next step is forward testing. What I do for forward testing is I obviously take the strategy and we go and take real money trades with it. However, I just take trades with, it can be one share, it can be $100. You can sort of go about that how you want. I like to sort of go with the couple $100 method, because then it gives every single strategy gets the same, or every single, should I say, trade gets the same position size, so that if I'm trading a $500 stock or a $10 stock, the profit isn't just like way off because of the cost of the ticker itself, right? So say you put $100, $200, whatever it is, into every single trade, then you journal every single trade you take. You're doing it, obviously, that's very low risk. You're putting a very small amount of money into each trade. So even if the strategy sucks, like it does not translate at all to real money trading, you're not going to lose a lot. But what you're looking for while you're journaling is you're looking for the statistics of the trades that you're now taking with real money to align with the statistics of your back test. If I begin to forward test this strategy that's showing on my chart here, I would expect to see a roughly 80% win rate and a roughly max drawdown percentage less than 5%. If I'm seeing that, then I know that the strategy is translating well from back testing to real money trading. And after, I would say, at least 50 trades, 50 real money trades, I even like to go to 100, somewhere in that range, 50 to 100 trades, I have built enough confidence that, okay, this is a strategy I am ready to add to my playbook, and I can begin taking real position sizes with it. So now the question then becomes, and backtesting gets a lot of hate because this, it's like, well, like, what is the point of backtesting, right? Yes, you've proven it works on stagnant data. Kind of who cares? The point is, taking 50 to 100 trades in a forward test takes a long time, especially if you're swing trading. Day trading, not as much. Scalping, really not as much. But for swing trading, it can take a long time to get 50 to 100 trades. And you do not want to skip that. You do not want to like only take 10 trades. It works in those 10 trades and then go. You don't have a large enough sample size. So the purpose of backtesting is twofold. One, if you don't prove it works, at least in backtesting, then very often you're going to just be wasting months and months and months of time just forward testing strategies that never had a chance, right? At least prove the strategy had a chance in backtesting before moving forward into forward testing with it. Next, backtesting gives you those baseline statistics. You know, hey, if this strategy trades at this win rate, at this average win to average loss ratio, and at this max drawdown, that it is going to make money. My back test has proven that. So as I mentioned, when you're doing your forward testing, you then have a baseline of statistics that you can compare against and know that if they are aligned, that the strategy is working and will make money over time. So back testing is still vitally important. So is forward testing. Obviously, they're both important, but back testing just is a necessary step in building proving trading strategies. All right, the 30 minutes is up. Click the like button if you learned something. Subscribe to the channel if you would like to continue learning. And remember to check out daytradingstrategies.net, linked in the description down below. At least go take advantage of the free codes over there and click on this video here to jump right into more education from myself.